All right, here we go. Welcome everyone to the 7-day crypto accelerator. If you're here, it means you're interested in learning how to navigate the wide world of crypto, which is really the world of decentralized finance. And of course, you want to stay safe while doing it. Now, for many of you, this will be the first time we meet. My name is Brandon, and I operate a mastermind community where we dig deep into all the different possibilities in the world of decentralized finance, talking about different strategies and approaches in order to, like I said, stay safe, but also, of course, make money and multiply our investment capital in the process. So, to kick us off today, I just want to give you an overview real quick of what the 7 days is going to be all about. And then we'll dig right in with day number one, which is laying the foundations for how yield farming actually works. So let me share my screen here. And here's what we got. The 7-day accelerator schedule, day number one, how yield farming works. That's what we're going to dig into today. One of the mechanisms that we use under the umbrella of our overarching strategy is yield farming. And outside the scope of a 7-day accelerator course like this, we can't get into everything, but this one, I believe, is the most important. It lays the foundation for everything else. And the cool thing is you can get started pretty quickly and start earning right away, even if you don't have all the other components of the big picture strategy in place. You can at least take a few steps forward just with the one mechanism of yield farming. Day two, we'll be funding your first wallet. So you'll see we're bouncing back and forth between kind of like conceptual education and knowledge, like, hey, here's the ideas behind it. And then on the flip side of that is like really nitty gritty practical stuff, like, hey, here's the button clicking that actually allows you to put these concepts into practice. So you really can't have one without the other, right? It's like if you go for a good fitness program, what's more important, weightlifting or nutrition? Well, you got to have both. If you don't have a balanced perspective on things, it's just not going to work. So same idea here. I'm going to be giving you some theory, education, training, but I'm also going to be giving you some practical button clicking, like nitty gritty how to, the nuts and bolts of it. So we're going to learn how to fund your first, what they call a Web3 wallet or a DeFi wallet, meaning I'm going to show you how to be self-custodian of your own assets. And that's super important because if you're storing crypto on a centralized exchange platform, such as Coinbase, Kraken, Binance.us, whatever the case, you are not actually in custody of your own assets. Okay, so we'll go over all that on day two. Day three, the strategic approach. This is where I'm going to lay out for you like the big picture perspective and where all the individual components actually fit into that big picture perspective. And then, of course, here on day one, we're just going to be talking about one of those big picture components, and we're going to go deep dive into it. Day number four, avoiding scams and staying safe. I've been doing this for a couple of years now in terms of running a mastermind community, teaching, training, educating people in the world of decentralized finance. And it breaks my heart every time I hear someone who lost 10,000, 20,000, 30,000, sometimes more, sometimes multiple six figures to a scam. Now, when I say scam, I don't mean, oh, the chart went down. What a bummer. It's a scam. No, charts go up and down all over the place, all over crypto, all the time. Like that's just the environment that you're playing in. When I say scam, I'm talking about, hey, give us your Bitcoin. We'll handle it for you, and then we'll give it back to you later. And they never give it back to you. Okay, so they're literally like stealing from you, but they're stealing with your permission, which is unfortunate. So I'm going to show you how to avoid all of those things all together and how to notice, how to identify them ahead of time. So if your buddy comes to you and says, hey, I saw this thing, like this looks legit, you can go, no, my friend, 100% that's a scam. Let me tell you why, because I'm equipped with that knowledge now. Okay, day five, your first liquidity position. A liquidity position is what you have to create in order to participate in yield farming. We'll go over that here in just a second. Day number six, the crypto investor's mindset. Now, I get it. Normally, mindset stuff is like at the very beginning of everything, but it's necessary. But obviously, there's some foundations to lay first. When I say the investor's mindset, I'm talking about developing the patient investor approach. Okay, you see, this group is called the patient investor. There's a reason for that. In crypto, there's a lot of hype. There's a lot of like, oh my God, 50x in a month, like this kind of wacky stuff. We're not playing in that space. Okay, so just let me get that out from the get go. If you're here to learn about moonshots and 100x and all that stuff, you're not going to be happy unless you're willing to adjust your approach, because in the world of crypto, you don't need 100x in 1 year to multiply your gains significantly and to seriously outperform any other possible in a asset class. Okay, so no, we're not doing 100x kind of wacky returns and stuff, but it's still going to be really, really amazing returns at the end of the day. So stick around if that's something that you're interested in. And then finally, day 7, harvesting your gains. That might not make sense now. That's okay. I'm basically just going to show you that, hey, after you go through this process of yield farming, you're going to produce some yield, right? Which is the fee income that you produce as a result of being a liquidity provider. And I'm going to show you how to harvest that, and then how to reallocate it, and how to build what we call a bull run portfolio. Okay, so that's the schedule. Let's dig in today, day 1, how yield farming actually works. I'm going to pull up my handy dandy whiteboard here just so we have a little visual to go along with it. So yes, we are talking about yield farming, and I'm going to lay out, like I said, we are going to go over the big picture strategy a little bit down the road. I just wanted to address this one on day 1 because it's something you may have heard about. So people talk about, oh, you can do staking, oh, you can do mining, oh, you can do yield farming. There's like a lot of different inputs that are coming at you, right? And at the end of the day, there's 100 different ways, maybe more, to make money in the world of decentralized finance. I'm just saying, hey, here's the one that, again, just this is in my experience, has worked the best for me. It's worked the best for my clients and students in the mastermind. And I want to share that approach with you so you understand, like, okay, I've heard about this thing called yield farming, but I don't fully understand it. What exactly is it? And one of the biggest questions that I get uh, from applicants who are considering joining the mastermind is, where do the gains come from? And what I mean by that is, when we talk about investing, most people can understand, because it's super simple and straightforward, buy low, sell high, right? If I buy, whether it's crypto or a share of Tesla, if I buy it at $100 and next year it's worth $200, I can sell that and I make money, right? That makes sense. Buy low, sell high. And there's nothing wrong with that. I'm not putting that down. I'm saying there are other mechanisms to build on top of the buy low, sell high approach. And that is where yield farming comes in. Now, again, in crypto, you're going, well, where does this extra money come from? Because typically in crypto, there's a lot of money out of thin air, right? If you followed the news, and FTX, you may have heard about that centralized exchange in Alameda, and Sam Bankman-Fried, and some of these like big names that have been pushed all over the media the last few years. He was a strong, and this is why he got in trouble. He basically was creating money out of thin air. He's like, hey, I just created a billion of these tokens, and now I'm using them as collateral to take out loans for real world dollars, and then I'm getting in trouble because I'm not managing that responsibly. So it's a legitimate question. Where do the gains come from? Is this just money out of thin air that is inherently inflationary and it's all going to collapse on itself tomorrow? No. Here's why. Yield farming is based on the premise that you become a liquidity provider. Okay, so in the world of decentralized finance, there are every day millions, probably hundreds of millions of swaps happening online. Okay, trades. And I'm going to use the most basic example just because these are probably two assets that most, if not all of you, are familiar with: Bitcoin and ETH. Currently, they are number 1 and number 2 by market cap in the entire world of decentralized finance. If I want to trade some of my Bitcoin and receive ETH, well, I can do that. But there has to be a decentralized exchange platform, we call that a DEX. There has to be a DEX upon which that I can make that trade. There is some sort of pool where both of these assets exist on a DEX, decentralized exchange platform, and I want to swap one for the other, meaning I want to put in Bitcoin and I want to receive back some ETH. Or I want to put in my ETH and I want to receive back an equivalent portion of Bitcoin. This probably makes sense to most people. I mean, this is the basics of like any asset trading. But in order for that to happen, there has to be this pool, and this pool must contain both Bitcoin and ETH. Okay. So the LP here stands for liquidity pool, meaning there's this big bucket and the bucket contains Bitcoin and ETH. Okay. And if I put one in, I can pull one out. If I put the other one in, I can pull the other one out. This is the foundation. You may have heard this phrase, AMM, automated market maker. This is the foundation of all of decentralized finance. Okay. And that's an important point because when I talk to you about becoming a liquidity provider, this is not a mechanism that's here today, gone tomorrow. It's not like a little trick that someone just invented and it's going to fall away. In some way, shape, or form, this concept is the foundation of how these markets are going to be formed. And ultimately, DeFi, we're talking about how people transact and innovations in how people exchange value. Okay. So that's definitely not going away. That's been in existence since the dawn of civilization. And more recently, in the last few hundred years, since the dawn of just markets in general. Okay. So this is just the next technological innovation in how markets are formed and how they operate. And again, how humans transact and exchange value. Okay. So understand that the technology, it's not just like, oh, what's this wacky cryptos that's floating around? No, it's like it's a new technological development. Okay, we'll get more into that later. I don't want to get lost in the weeds too much here. Okay, so you become a liquidity provider. How do you do that? Well, I'll kind of walk you through over the 7 days. Hey, here's the mechanics of how you pair two assets together, how you become a liquidity provider, and then you receive a reward for that. But again, we're back to the question, where do the gains actually come from? Well, anytime there are transactions happening in the world of decentralized finance, it costs something. And I'm going to put a dollar sign, even though we're not talking about dollars, we're talking about crypto assets. But if I want to, like, let's say I'm on the Ethereum network, okay? In the world of DeFi, there are many networks, many different blockchains, but let's say I'm on the Ethereum network and I want to trade. And if I was doing that, this would be technically, it would be wrapped Bitcoin. So don't worry too much about what that means. It just means Bitcoin on a different network. So I got wrapped Bitcoin and ETH. If I want to swap my ETH and receive wrapped Bitcoin, or my wrapped Bitcoin and receive ETH, it doesn't matter which direction I'm going in, it is going to cost me a transaction fee. Okay. So there will always be transaction fees. And you may have heard of the gas fees, which is part of the whole process. Basically, what we're saying is if you want to transact on the Ethereum network, you have to pay the transaction fees, gas fees, with ETH, meaning that asset in and of itself has inherent value because it is the fuel, if you will, to fund transactions on that network, whatever that might be. Okay. So there's a transaction fee. Now, let's say that transaction fee, I'm just going to keep it super simple for the sake of illustration here. Let's just say it's $1, or rather the equivalent of $1 of ETH, whatever that might be. Okay. Ethereum, this is May 2nd, 24 right now. Ethereum is, I didn't even check it this morning. It's around 3,000, 3,100 or so. So, it would be like 0.0001 ETH or whatever the fraction is. I don't even know. But the point is you're paying something in order to transact. So if I'm a trader, I need a service. The DEX is providing me a service and they're saying, hey, Mr. Trader, if you want to use our platform, that's a service. We're going to charge you a fee for that. And the trader goes, I'm okay with that because I'm receiving a service, I'm receiving value in exchange for a transaction fee. So you can think of it like a business in that sense. Like in a normal business, if I want a service, I pay for the service, and that makes sense because that's what fuels an economy. So this dollar, or whatever that transaction fee is now floating around in space. Well, what happens? Well, number one, the DEX, they want a cut of that because they're the ones providing the service and they should be compensated accordingly. But you, as a liquidity provider, I'll explain more about that in a second, but you, as a liquidity provider, you also get a portion of the trading fees that are generated when this transaction happens. So you are, in effect, you are providing a service in a decentralized environment, and you are getting compensated for the service that you provide. That's why this is a critical distinction, because it's not just money out of thin air. It's you offering something and being rewarded in return for it. So you are providing real value to an ecosystem of various services and platforms and smart contracts, and you're getting compensated for that, which makes sense. Okay. So what does it mean to become a liquidity provider? Well, in a nutshell, and I'm going to use Bitcoin and ETH again as our example, just because, again, those are two easy assets to understand. Let's say in my wallet, in my DeFi wallet, I have some Bitcoin and I have some Ethereum. I could hold these assets in my wallet unpaired, meaning I'm just holding them. I have a Bitcoin, I have some ETH. Great. I'm just going to wait around for 10 years. They will likely appreciate in value. Okay. We're past the point where it's like, Bitcoin's going to explode tomorrow. So in all likelihood, they'll appreciate in value. And I could hold those and then sell for a profit. Nothing wrong with that. Or I could hold them and then offer a portion of them to a liquidity pool. So for the sake of illustration, let's say this liquidity pool has nothing in it. Okay. That's not really the case. Typically, when you join a liquidity pool, there are already assets in there, but let's just pretend for the sake of illustration that this liquidity pool is completely empty. No one can swap in this. No one can do anything in this pool. It'd be like if you had a real swimming pool and there was just no water in it. It'd be like, okay, it's boring. But if there's something in there, now people can transact. And let's say you would like to be a liquidity provider for this pool. And you go, okay, I'm going to provide $5,000 worth of Bitcoin. Okay, so right now that would be like about, I don't know, not even 0.1. It'd be a little bit less here, so like 0.08. I don't know what the math is. So I provide a Bitcoin that is on that day in the market, the equivalent to $5,000. And then I'm going to provide an equal amount of ETH. So let's say $5,000 worth of ETH, whatever that is, 1.3 or something like that. And I'm going to mash those two assets together and create what's called an LP, a liquidity pool token. And I'm going to mash these two together. And I'm going to put that in the pool. Now, immediately after I do that, this pool has the equivalent of $10,000 worth of both Bitcoin and ETH. Now, this other little trader comes along and he says, hey, I have a whole bunch of ETH, but I want some Bitcoin. Okay. So I've got $100 worth of ETH that I want to add to this pool. In exchange for that, I want to receive back $100 worth of Bitcoin. And so now the pool will have a slightly different distribution because you put in 50-50 Bitcoin ETH. The pool now has a slightly different distribution of ETH and Bitcoin because this guy put in a little ETH and pulled out a little Bitcoin, okay? And another trader might come in, put in a little Bitcoin, take out a little ETH, and now the pool's right back to the same balance that it was originally, okay? So the point here is this little trader man, he came over here with his assets and put them in the pool, got some other assets back, and he had to pay, and again, we're just using illustrations here. This is not the exact amount, but let's say he had to pay $1. And you go, cool. Now you're over here as the liquidity provider. And you go, hey, that's great. That $1, I'm going to get a portion of that because I was a liquidity provider. Now, on the surface, you go, okay, Brandon, you're telling me that you're going to provide $10,000 worth of capital, become a liquidity provider, and earn $1 in return. That sounds stupid. No, this is just the illustration of what's happening because realistically, there are millions of this guy constantly swapping, and you are not the only liquidity provider. So if you were the only liquidity provider, you would get the lion's share of that portion of trading fee income from that pool. But let's say there's actually in total 1 million in here. Well, 10,000 is 1% of 1 million. You would be providing 1% of the liquidity in that pool. Meaning, if this pool then generates, I don't know, let's say 50,000 in trading fee rewards over the course of a day, you would get 1% of that. And you go, well, hold on, Brandon, that's only $50. This still doesn't sound very good. But remember, that's just a daily return, okay? And if this was a perfect example, a $50 return on a $10,000 investment, well, that would be, let's see, $100 would be 1%. So this would be 0.5% return for the day. And then, well, multiply that by 365. What do you get? Holy cow, now you're talking about 180% returns. We're talking about more than doubling, almost tripling my initial capital investment just from these trading fee income rewards. Now, again, this is just an illustration. I'm not saying every pool is going to return 0.5% a day. But what we are finding with our investors in the mastermind and my personal experience as well, that on average, once you kind of diversify and hedge and like all things considered, just your trading fee, and this is not dollar, just your trading fee income, meaning the rewards that you receive by being a liquidity provider, providing value to the ecosystem, the rewards that you receive on average range from 50 to 100% APR. Now, a couple things to consider. Number one, this is with blue chip crypto assets. This is like, hey, I want to pair up Bitcoin and USDC, and I'm going to land like around 70% APR. That's really good return on its own. When you consider that like normal stocks is like 8 to 10% per year, and you're like crushing it if you average that. What we're talking about here is 50 to 100% APR, and that's just in the rewards that you receive from becoming a liquidity provider. You have to add to that any long-term appreciation of those base assets, because in our little example here, sure, you started with 10,000, but here we are. I mean, again, it's May of 24. Here we are leading into the next big bull run, which will likely continue for 12 to 18 months. We don't know exactly how long, but in all likelihood, that's where we're headed. I started with 10,000 in capital, but over time, Bitcoin and ETH will likely appreciate and they'll go up in value. And I don't know how much exactly, but let's just take a reasonable estimate. Let's say they only go up 2x from where they are right now. Cool. So that means I'm going to double that initial investment, which I could have just held those assets and gotten that as well. But then I'm going to add to that the reward incentives that I got by being a liquidity provider. So this is, and again, this is just one of the mechanisms we use in the mastermind, but you can see how even just this one mechanism is already stacking gains on gains on gains. Okay. And then when we add all the other components, it's like more gains, more gains, more gains, more gains. Excuse me. And when we get into the day on the strategic approach, I'm going to just kind of outline for you what those other bits are and what the potential is for utilizing a strategy like this. Okay, so that is it in a nutshell of becoming a liquidity provider. And I don't want these videos to be too long. I want it to be kind of like short and sweet. Boom, let me introduce you to an idea and we'll dig into it more as we go. But suffice it to say, if you get anything out of this lesson, this is kind of like the summary, like, hey, if you forget everything else you learned today, what's the one thing you should take away? Is that you earn by providing value. Okay. And that is, to me, that's the most important distinction here, is you are making a trading platform safer, faster, more reliable for the millions and someday billions of users that want to use those trading platforms. This is the foundation of the infrastructure of the new world of decentralized finance. That is what is being built right now. It's like if we could go back in time and take a look at some of like the infrastructure of maybe computer programming languages, that's kind of like what we're talking about. You talk about the advent of the internet, right? At first, the internet was just like, it's just a bunch of computers connected together. And then someone realized, oh, but we need a way to like catalog this. And then eventually someone figured out, oh, we need a way to search for certain things on this. Meaning there was this loose infrastructure, and then other people came along and said, well, we need to add components to make it safer, faster, more reliable, and more user-friendly for everyone. That's what where we're at with decentralized finance. Right now, it feels kind of like weird and like, what even is this thing? What are these cryptos? I don't get it. But right now, this is why it's a technological innovation. Right now, the foundation, the infrastructure is being built. And we're talking about becoming an investor in the early foundations of the infrastructure of what will become the future of how humans transact and how humans exchange value. And you, at this stage, you have an opportunity to become a liquidity provider. And as such, you can earn by providing value to this new and emerging ecosystem of decentralized finance. So that is like, that's the takeaway. Okay. And yeah, you can rewatch this if you want to learn about all like, oh, what does that mean in the pool and how do you put it in and where are the trading fees? How do I earn my, like there's all those little bits and pieces. But if you understand this conceptually, like you're ahead of 99% of humanity at this point, because most people are just going like, I don't know what a crypto is. Should I buy Dogecoin? And you can go, yeah, if you just want to like buy a silly coin that was from the beginning had no value and everyone said it has no value, go for it. Like knock yourself out. But there are other ways to be a part of the decentralized finance ecosystem, to become an actual investor and switch your perspective from, oh, short-term trader, I'm going to make money this month, to I'm going to make money on a daily basis. And it's not going to be much on the daily, but I'm going to slowly accumulate over time. And that accumulation will bring me on average 50 to 100% per year just from this one extra piece, not even including like the appreciation of my base assets and some other variables that I'll show you further along as we go. Okay, that's all for today's training. All right. Now you're going to have a homework sheet that has the video links for all this stuff. If you have any questions, follow-ups to this or whatnot, you drop those in the Facebook group and tag me. Okay. If you don't tag me, I might see it, but it's unlikely. Tag me, just @ Brandon Hofer. I'm in there. Like you can find me in the Facebook group. It's really me. It's not like my virtual assistant. It's really me. And there are a few other admins in the group as well who are coaches on my team, and they might be responding also. But either way, one of us will, and we'll address whatever we can in the context of answering a question on a Facebook post. But the Patient Investor Crypto and DeFi, that is the Facebook group. That's what you join to get access to this material. And let's make this interactive. Okay. Yeah, you can watch 7 videos over 7 days. I mean, you could watch them all in one day if you wanted to. But the point is, if every day you do just one piece, and then every day you follow it up with a question and some discussion and interaction, you're infinitely more likely to actually learn the thing, right? Because everybody just wants to consume material, more information. Well, information's nice, but if you don't do anything with it, ultimately it's useless, right? So that's why we're kind of dancing back and forth between, hey, one day the lesson is like conceptual, the next day it's like extremely practical, button clicking, nuts and bolts. So all that to say, be a participant, interact with us. Don't just be a fly on the wall going like, I'm going to watch this for 2 years before I take action. No, this is designed so that over the course of 7 days, you can take action. You can start making money immediately by becoming a liquidity provider. And we're going to walk you through that process. Okay. So stick around, ask questions, be friendly, be present in the whole process. And ultimately, you're going to get out of this experience whatever you are willing to put into it energetically. Okay. Yeah, I'm providing this training for free for anyone to come along and take kind of first steps. But ultimately, there might be an opportunity to take it to the next level beyond the 7 days if you want to. And I'll explain a little bit more like what that means as we go. But this is the first big step, especially if you've never participated in crypto or DeFi before and you want to. This is your first big step forward, becoming self-custody of your own assets, becoming a liquidity provider, avoiding scams, and ultimately developing a long-term value investor mentality and strategy that will lead to the types of gains that we're going to be talking about. Okay, that's it. Day one, it's in the books. I will see you at the next training. Have a good one.